Now let us understand as far as the operational risk is concerned, one of the most important mitigant is the control. So for any product or for any kind of risk, there is always an inherent risk. Inherent risk is which is built in while doing a particular kind of an activity. Inherent risk is credit risk is inherent in all lending activity. So now when we say this, inherent risk basically can be low and could be high, and we have said that in case of an operational risk, we have to live with the low impact and low incident kind of a thing, which doesn't really are part of the operations, and the organization has to live with that. If the inherent risk is high, then is it this inherent risk is controllable? That's the next thing we have to ask. And if it is yes, then you necessarily have to find out some suitable controls. And when you set up a control, then definitely you have to follow up with whether the controls themselves are working properly. So the compliance of the setup controls, and whether the controls are also whether they are adequate over the period, because whatever control you do for an operational risk event today may not hold good after a time, because it's all dynamic. So if you are don't have you cannot, they are not controllable. If your answer to the this question whether they are controllable, it's no, then probably the organization is left with either whether I have an option to pass it on, or whether I can transfer this risk, or whether the ultimate is let me not do this activity, or if possible insure against the kind of a risk that the organization is facing. On if the activity is very, very critical for the survival of the organization, then it's a kind of have to accept those kind of risk, though it is highly uncontrollable. Now, how do you mitigate operational risk? It's unfortunately there are not many kind of derivative instruments which are available for operational risk. The operational risk definitely has a limited scope of getting your operational risk transferred to somebody else. So because it is coming out of the people and the process, it's our own people, your own processes, systems. So probably it can only be better controlled by the organization itself. So the damage to the natural disaster, fire, etc., we know that insurance can be taken, and losses from disruption, electricity or telecommunication, always we have most of the organization have the backup facility. And losses due to internal reasons involving people, process, systems. Basically, you need to have a very strong internal audit procedure. So, strong internal audit procedure and becomes very important for controlling the internal factors which are responsible for the operational risk losses. And if there are to the severe business disruption, most of the organizations do have what is known as a business continuity plan. So like your system totally failing, whether you can fall back to a manual system and at least keep your critical operations running. So basically that is what is the BCP is all about. So mitigants should be put in place to be reviewed periodically, because as I said, operational risk events are not unique. They keep on changing, and you will next time will have a different kind of event. So the mitigants put in place to be reviewed periodically to ensure that contingency strategies remain consistent with the current operations, risk and threats, resiliency requirement, and to facilitate the business continuity with minimum loss of times. Now to summarize on the operational risk, ensure that the risk we accept are within the risk appetite, risk tolerance of the bank. This is applicable to any kind of risk, whether it is market, credit, and operational risk. Ensure risk mitigants, business continuity plans are put in place wherever we are exposed to risk. And it's always said, you must have a proper trade-off between risk and return. So risk and trade-off becomes very, very critical. But in case of an operation, it's very, very difficult to quantify, the trade-off, because some activities have to be undertaken irrespective of the impact it's likely to happen on the organization. So it becomes a very kind of a tricky, or basically that is why we say that operational risk measurement is more of an art than science. Then spreading risk culture in the bank is very, very critical, because operations risk originates from people, systems and processes. So most of the financial institutions, banks rely basically on the staff to carry out most of their activities. So the spreading the risk culture, and you are always exposed to the customers, and we probably cannot do the business without interacting or getting exposed to the customers directly. So that is where the spreading of risk culture in the banks becomes very, very important. And historically also we have seen most of the operational risk losses had the role of an insider in most of the cases. So it becomes very, very critical to make aware everybody about the the awareness about risk culture in the organization is very, very important. Then risk management framework must be closely integrated into the day-to-day risk management processes of the bank. It's not enough to have good policies and a good framework at head office. What is more important is to integrate that closely with your day-to-day operations. Ultimately, the operational risk events come out of your daily operations. Now let us talk about the integrated risk management. Now what is the meaning of integrated risk management? Integrated risk management, or enterprise-wide risk management as it is known, is managing all the risk associated with all the activities business line in an integrated manner, and in the process optimize the returns by getting the benefit of diversification and also avoid excessive exposure to a particular kind of risk. In any organization, particularly organization which has a large geographical presence and different product lines, all these kinds of risk, basically what we discuss, exist in all the business operations. So it is very necessary for an organization at the top level to monitor them in a centralized place. You cannot decentralize risk management. You can probably decentralize risk management functions like take controls and all, but when it comes to aggregation, it's always it makes sense to have an aggregated view at the top level. So that is what integrated risk management is about. In this, because the different people will be taking different risk and different sections, and sometimes the concentration risk can come up if the same counterparty, you are exposed to the same counterparty across the organization without anybody actually monitoring how much is the kind of an exposure you have on that particular party. Need for integrated risk management comes because we need to integrate an organization's internal external business processes. This is very important. We have seen that the operational risk comes out of the internal as well as the external events. Centralize the process of supervising the risk. That is where you need to integrate. If you need to supervise at the central place, you need to integrate, and you should have a holistic view of the total risk the organization is facing. And this will help if you know in an aggregated level the kind of risk the organization is facing across the business lines. Probably you are in a better position to decide whether the organization per se should retain the risk, or what are the the controlling, limiting, how do you control and limit those kind of risk across the organization. And probably if there is a possibility, the organization can take a view at the the centralized level to see whether this can be transferred. Particularly in case of an insurance and kind of thing. And it also helps to restrict what is known as the worst scenarios in the organization, which basically helps to restrict the downside potential at the organizational level rather than handling them at individual business units or business lines. And it also, we know that the risk and reward, there is a correlation. So probably it also helps to capitalize on the upward potential of the risk if you have a a centralized or integrated risk management system. We must know that the integrated risk management is basically an inventory. It's not a one single tool. It's a framework, it's a process, and it's a culture, and it's a decision supporting tool, and it's effective when customized for each organization, because we cannot have a standardized IRM framework for all the organization. Each organization has to devise their own integrated risk management setup depending on the risk, kind of operation the organization is having. And the basically the integrated risk management is only as strong as its weakest component. So if you have very weak component basically which exposes the organization to a higher risk, basically your the integrated risk management has to be very strong. And what IRM is not, it is not a substitute for the expert judgment. So that everybody who uses IRM should be aware of it. And it's not an insurance policy. It doesn't per se say that if you have a integrated risk management, okay, this is works as a mitigant. Definitely, it's an control part, but it doesn't really work as a mitigant like an insurance policy. It's not a compliance function again. It has to be, and it's not a cost center. Basically, when we say that, basically that is how the risk management functions are looked in the organization, but it is not a cost center. And it's not very precise, and it's not very static. It's very dynamic, because the integrated risk management itself is basically an integration of different kind of risk, and each kind of risk is very dynamic. So when you say that each of the component of the IRM is dynamic, the IRM itself becomes very dynamic. And the one size fits all doesn't apply to IRM. That's what we said. Each organization has to assess its own setup to meet the IRM objectives. So what are the benefits of the integrated risk management? It helps in tracking organization changing risk profile, because you are aggregating at the central level. We come to know about the risk profile of the bank. It helps in risk concentrations, because concentration can be limited if you have a centralized limit setting place. And if you identify some kind of a risk, it always helps to mitigate them. So some specific risk can be mitigated if you have the integrated IRM setup in place. And you can always assess the enterprise level impact of internal decisions and external factors. So being at the central place, in having access to all the kind of data and processes across the organization, you are better placed to assess the enterprise-wise impact. And all the organizations are looking for maximum return on their capital. So it always helps. When I say capital, it could be the human capital, it could be the systems, it could be the real capital. So the allocate resources to business with the highest return on risk. This is when you do a risk-adjusted return analysis of different business classes, you will be able to do this, allocate a business where the returns are maximum. And tie executive compensation to risk-adjusted profits rather than just declaring or deciding on the bonuses based on the gross profit. Price product to risk. Basically, you have to price all the risk in the product, not just follow the market. And manage capital availability. And again, top of it, very important is the regulators also are insisting that you must look across all your business lines and activities and assess your capital adequacy. So it helps to demonstrate capital adequacy to regulators, rating agencies, and stock analysts. IRM approach, basically you need a proper organization structure to manage risk at the apex level, and you need policies which basically follow the top-down approach. You set up the policies, and the people down the line have to follow that. So integration of the risk limits, basically this is what we know as everybody talks on the same language when it comes to risk. That basically comes out of when you integrate the risk limits. And integrated risk reporting, it helps the management to take a holistic view. And accordingly, you can have the systems to integrate your IT architecture so that IRM is possible using these systems. So the conceptual framework for IRM determine firm's risk appetite. That's very important. It could be, in case of a bank, it could be your CRAR target or the external rating target for the bank's long-term debt. So that can be a target or risk appetite which you can mention. Or sometimes the NPA ratio also becomes a sort of a risk appetite a bank can put. Then estimate the capital needed to support the desired level of risk. That is very important. And then determine the optimal combination of risk and capital so that you achieve the desired CRAR or the external rating or the kind of NPA ratios for the bank. Very important part is the decentralize the management of risk, because it's very important, because the risk gets originated at the grassroots level, at the operation level. So it is better the risk assessment takes place where it happens. So the important part is risk assessment by those who actually are close to the risk. So, and it also brings in the ownership of the risk. When you decentralize, the people understand, yes, this is it's not that I go on doing the business without actually knowing what is the kind of risk I am taking. So it gives a better monitoring for the business heads. And it also transforms the risk management culture. So what we said across the organization, everybody must be aware of the risk the organization is facing. So it helps in spreading the risk culture. So let us check the progress on the operational risk and integrated risk management that we discussed so far. Operational risk includes legal, strategic and reputational risk, legal risk but excludes strategic and reputational risk, concentration risk and liquidity risk. The legal, the Basel definition says the legal risk, the operational risk includes legal risk but excludes strategic and reputational risk. So B is the correct answer. Key risk indicators. We have seen that basically they are the early warning signals. So provide an early warning of future losses, provide indicators for evaluation of the employee's performance, they are not, are indicators of economic performance, they are not, will be same for all types of activities. We have seen that the KRIs comes out of the risk and control self-assessment. So they will be different for different processes and different activities. Though A, provide an early warning of future losses, is the correct answer. Which of the following is permitted by regulators as a mitigant to reduce operational risk charge? Risk limit across the business line. This is basically a sort of a control. It's not a mitigant. Insurance up to specified percentage of capital charge. Tier 1 capital instead of Tier 2 capital. Again, this the Tier 1 capital is a better, least risk absorbent, but that doesn't mean that it can work as a mitigant for the operational risk. Risk-based internal audit is a part of, again, control. So the B, insurance up to a specified percentage of capital charge. That is what the regulators have permitted. So that's the correct answer. To estimate level of future operational risk, profit estimates are enough. They are not enough, because we cannot estimate the level of future operational risk based on the profit estimates. Historical profit figures are enough. Again, as same logic, we cannot decide on the operational risk future operational risk based on the historical profit. Historical fraud details are enough, because this is also not correct, because frauds are only one part of operational risk we have seen. There are different 8 types of loss events. 7 types of loss events which are contributing to the operational risk loss. So what is required for assessment of future operational risk is probability of occurrence, the frequency with which the operational risk event will take place, and the impact, potential financial impact, and impact of internal controls are necessary. So D is the correct answer, because to estimate level of future operational risk, the probability and the potential financial impact and the kind of internal controls, because they work as sort of mitigants for the operational risk. So D is the correct answer. One of the benefits of the integrated risk management, IRM, is it facilitates evaluation of the pricing decisions and product profitability. It helps grow business without having necessary capital. Business cannot grow without capital, so this is not correct. It can take over compliance function. Definitely it's not, it cannot replace compliance function. We have seen that. What is IRM and what is not IRM? We have seen that compliance function is not IRM. It can be used as a substitute for expert judgment. We have seen that IRM cannot replace expert judgment. The correct answer is A. It facilitates evaluation of pricing decisions and product prosperity. Thank you.